All right, it's talk time now. Nigeria's monetary policy rate has been left unchanged at 14%, and the Central Bank's Monetary Policy Committee also retained the cash reserve requirement and liquidity ratio, citing the prevailing economic conditions.
Lara Folayan has details of that.
It is the first Monetary Policy Committee meeting for the year. The monetary policy stance from last year is now being maintained. The decision makers here say a rate cut at this time is unnecessary. This is because it could worsen inflationary conditions, stifle growth and undermine the stability outlook for the foreign exchange market.
The committee also feels that doing so would further aggravate demand pressures while undermining existing income levels in the face of the already expansionary monetary policy and increasing inflationary pressures, which will make the economy unattractive for foreign and domestic investment. In summary, MPC decided to 1. Retain MPR at 14%, retain the CRR at 22.5%, retain the liquidity ratio at 30%, and retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR.
The country's foreign reserves now stand at $28.9 billion, but the Apex Bank says this does not necessitate floating the naira. It adds that foreign exchange will be made available to critical sectors to help bridge the gap between official and parallel market rates. It as well notes the impact of the macroeconomic environment on the banking sector, while seeking that the Apex Bank meets with players on the issue.
The MPC urged management of the bank to engage industry operators to discuss likely issues of assets quality, credit concentration, and high foreign exchange exposures. What we will try from time to time is to make more foreign exchange available within our own within limits of available resources to those sectors that we consider priority sectors. And so we'll continue to do that, and hoping that as we increasingly do that, the urge for people to go to what I regard as illegal markets, I think hopefully will reduce.
The committee is positive the 2017 budget should boost output growth, but seeks its early finalization. It advises that the country pursues public-private partnerships in infrastructure financing to cushion revenue shocks. The committee once again canvassed greater synergy between fiscal and monetary policies. Lara Folayan, TVC News, Abuja.
Right, we have with us in the studio a financial analyst, Johnson Chukwu, and also an economist, Paul Igbinoba, to take a look at this indices, how that will affect Nigeria's economy. Will it help it grow? Because that's the essence, really. But let's start with you, Johnson. MPR pegged at 14%. Since 2016, I think July, that was when the MPR moved from 13% to 14%. And from then, it's been that way. Your take on that?
Well, the central bank policy has been to focus on managing the exchange rate and inflation pressure. And that was why the central bank said that irrespective of the fact that the economy has not started growing, the economy is still in recession, that they still have a primary duty to maintain price stability. Keeping the MPR at 14% for me has become perfunctory. It has lost its primary objective. You see, the liquidity we have today would not be materially affected by any movement in MPR. If we want to address the liquidity issues, if we want to improve liquidity, we need to look at the cash reserve ratio. That is the element that has taken out liquidity from the banking system. So if you want to restore liquidity in the banking system, you have to drop the cash reserve ratio from 22.5%. If you move the monetary policy rate, unfortunately, the structure of the Nigerian economy is so that the monetary policy rate, in as much as it's supposed to be a guide, it's supposed to be the benchmark, is basically more of a notional guide. It does not really determine the ruling interest rate. Today, what is determining the ruling interest rate is the yield of federal government debt instruments, short-term debt instruments, the treasury bills.
Yeah, which is why some people say that's why CBN is keeping it at that particular rate, because it's helping the federal government with the securities.
You know, the challenge I have is to say he's helping the federal government with this to raise its own debt, to issue its debt, I don't think it's real, because the truth is that if you want to decompose the structure of the economy, which is a lot of time we don't do, the structure of the economy is so that the lending outlet, the surplus units, which are the PFAs, the cooperative societies, the banks, do not have the wherewithal to invest in instruments outside the country. So they are limited to investing in Nigerian instruments. And if they're limited to invest in Nigerian instruments, irrespective of what yield the federal government debt instruments offer, they will invest their excess liquidity in those instruments, because there are not many alternative investment outlets in the country. So we've seen situation under Sanusi's government, under Sanusi's leadership of central bank, in 2008 to 2010, when yield on federal government debt instruments, particularly treasury bills and bonds, treasury bills dropped to less than 2%. And banks were scrambling to still put their money in those instruments. I remember when we did one particular state bond, PFAs were begging us to subscribe to those bonds, and the yield was 13%. So the key thing is, even if you drop the monetary policy rate, even if you drop the yield on federal government treasury bills, institutional investors will still invest their money, because they don't have the way with that to go and invest in South Africa or invest in Ghana, because there is an exchange rate, exchange control challenge they have to overcome.
Okay, let me bring in Paul in here. Still talking about the maintenance or the sustenance of this rate, the MPR, liquidity ratio and all of that. This has been through 2016 and we still were in recession. Yeah. So if this is still maintained, do you see it as any strategy to revamp the economy or any growth that will enhance any growth?
Well, you could see that basically the primary concern of the Central Bank of Nigeria is inflation targeting and also to ensure stability as much as possible in the foreign exchange rate. Their policies are not growth oriented. You know, the economy is in recession, but you can see that Central Bank, if you ask me, has basically boxed itself into a corner by emphasizing on the use of capital control strategies, by emphasizing or by adopting administrative measures to manage the foreign exchange market. You know, I mean, the situation we have in the country with recession, with little or no foreign exchange flowing in, apart from what we earn from oil exports, CBN is in a tight corner. The nation is suffering from severe liquidity, scenario in terms of foreign exchange and even in the domestic economy. And the way forward is to minimize administrative controls. The way forward is to allow the market to have its way. And when you do that, in a short term, there will be some, of course, challenges. The risk will go up, but in the medium to long term, things will stabilize.
According to the CBN, they are maintaining this rate not to even allow that free flow. So it's working against the economy. Is that what you're saying?
What I'm saying is that the current stance and attitude of the central bank really will not get the economy anywhere.
Okay.
Okay, we'll come back to this. Now, the Central Bank of Nigeria, after its first Monetary Policy Committee meeting in 2017, which held on January 23rd and 24th, left its monetary policy rate, the MPR, unchanged. We've been talking about this since, and the MPR was retained at 14%. We heard the CBN governor said that earlier on. The liquidity ratio, the LR, and the cash reserve ratio were also unchanged.
While the liquidity ratio remains 30%, the CRR is 22.50%. The MPR is the benchmark interest rate at which the central bank lends to commercial banks. The liquidity ratio measures the ability of a company to pay off both its current and long-term liabilities as they become due.
The CRR sets the specified minimum fraction of customers' total deposits commercial banks can hold as reserves either in cash or deposits with the central bank. Now, Governor of the Central Bank, Godwin Emefiele, said the decision was reached after the committee members considered the country's economic outlook.
Mr. Emefiele explained that the decision to retain the rates was to avoid worsening the inflationary conditions and undermine the current economic outlook for stability in the foreign exchange market. Paul Igbinoba is not on the same page with the CBN on that matter. Other external factors that contributed to the MPC's decision include Brexit, the retreat from globalization and free trade in the Western economies, and disorderly commodity price movement. Let's bring Johnson Chukwu in here on what the Central Bank said on the issue of Brexit, globalization. How would that affect us? And the MPRs and the CRR?
Well, the key thing is that the globalization, the reversal of globalization, that is a tendency that we're seeing in the West. We've seen a Brexit, which is a policy that looks at more nationalistic economic orientation, political orientation, will also affect, will also engender more nationalistic economic orientation. We've also seen the election of Donald Trump, as he's sworn in USA. We've seen the first set of policies he has come up with, one of which he has cancelled TPP, which is a Trans-Pacific Partnership. He is threatening NAFTA, the North American Free Trade Agreement, with signing executive order to build a wall separating US and Mexico. I remember NAFTA has only 3 countries. So we are seeing more nationalistic policies. And
even the policies on immigration.
Yeah, what that means is that even investment flow may have to reduce. Investment flow from the West, because once countries evolve policies that discourage their country, corporate institutions from investing outside the country, like what the US is saying, that you have to come and set up your manufacturing outfits, they're going to penalize companies that invest outside the US. So what that means is that a lot of corporate organizations that we are more globally looking will become inward looking.
In terms of FDI?
In terms of FDI, okay. In terms of FPI. And that will reduce the flow of foreign currencies into emerging markets like Nigeria. And that will obviously reduce the available liquidity that we can enjoy as a country. But I also must make mention of one fact that people are beginning to tend to overlook. The Trump government says their emphasis is that the U.S. economy should be growing about 3.5 to 4%. Currently, the U.S. economy is growing about 1.5 to 2%. And Yellen, the Federal Reserve chair lady, position is that at 2%, they need to begin to apply brake. They need to begin to increase benchmark rate. But if there has to be harmony between her position and the Trump's position, then it simply means that they will not begin to apply brake. They may not necessarily increase rates, which one expects that will begin to happen in the immediate future. If they have to allow the U.S. economy to get to 3.54% growth, which for the Federal Reserve, they think that will lead to overheating and increase in inflation rate.
Okay.
So we must juxtapose both factors.
We'll come back to this. Let's go on a break, and we come back to dwell more on these issues. Stay with us on TVC Breakfast. All right, if you're just joining us, you're watching TVC Breakfast. On this segment, we're discussing the outcome of the Central Bank, the Monetary Policy Committee that met recently, and we are looking at the prospects for the Nigerian economy in 2017. We have with us Johnson Chukwu, a financial analyst, with us in the studio. We also have an economist, Paul Igbinoba, joining us in here. Now, Paul, let me come to you on this. The international price of crude oil is phenomenal when it comes to the impact it has on Nigeria, being the fact that crude oil is one thing that the country depends on. We see the price, because of the agreement of OPEC countries to cut down the output, the price seems to be soaring a little bit. But it has soared. But the non-OPEC oil producing companies certainly are not on the same page when it comes to cuts. So in the long run, what prospects do you see for Nigeria economy in this from that window?
Even the non-OPEC countries have agreed to also cut back. While OPEC is cutting back by 1.2 million barrels, the non-OPEC are cutting back by about 600,000 barrels, and half of that will be taken by Russia. So I think that there's a consensus among oil producers, OPEC and non-OPEC, to actually cut back on oil production, and they have done that, and that's why we see the the increase in the price of crude oil, over $55 per barrel, and well, Nigeria relies almost exclusively, 90% or more, on oil exports, crude oil exports for its foreign exchange earnings. We will have to quickly, as quickly as possible, move away from that. And that means that government should really focus on strategies to diversify the export sector. When people say that Nigerian economy is not diversified, it's not true. The economy is well diversified. Oil production, oil and gas sector contributes just about less than 10% of our GDP. But what is not diversified is our export base. Our export base is very narrow and is monocultural, meaning that we depend almost exclusively on one export product. We have to move quickly away from that. But I don't see those kind of aggressive policies from government to achieve that. We were still focused on oil. We're talking about agriculture. Agriculture is okay, but it doesn't have the dynamism and the speed of diversification in terms of foreign exchange earnings. So we really have to emphasize greatly on manufacturing, do all we can to really increase the rate at which we diversify the export sector.
Okay, all right. Johnson, according to the CBN governor now, our foreign reserves have been boosted at $28.9 billion as we speak. Really, something good is happening somewhere. Is it?
Okay, yes. In terms of figures of 28.9 billion, that looks quite encouraging. But there are several things you have to take into cognizance in assessing that figure. There are still a lot of unmet demand, backlog of arrears, of payment obligations, and you need to adjust for that. There are a couple of currency swaps that the central bank has entered into with financial institutions, both locally and internationally. You have to adjust for that. So it's only when you effect those adjustments that you will actually be able to determine the actual unencumbered reserve of the country. And if we have an unencumbered reserve of 28.9 billion, we should begin to see Naira appreciate. I do not think we have an unencumbered reserve of 28.9 billion. So, and the central bank,
is just cooked up?
Well, we will say cooked up. I have mentioned some components of that reserve that you need to adjust for. They are real. You have to adjust for. The central bank just announced that they're going to do a special intervention, retail intervention, forward, 2 to 5 months forward this week. I think this week or next week. I think they did it yesterday or so, thereabout. And I don't know how much is involved. But you need to begin to clear those arrears before you achieve stability.
It's $4 billion.
It is those arrears that are creating the uncertainty in the FS market. Only yesterday, Fitch downgraded the Nigeria's economic outlook to negative.
Exactly.
So if you have a reserve of 28.9 billion unencumbered, mark the word unencumbered, then you couldn't be talking of downgrading of your long-term debt outlook. You should be talking of upgrading, because that should account for more than 5 months of import. But I don't think we really have that. But let's CBN do more of interventions and clear the arrears. When we clear the arrears and we're meeting demands as they come due, then you will achieve stability and confidence will come back to the first market.
Okay. Let me stay with you in here, or let me come to Paul in here. Now, when it comes to national economic interest, we mentioned it earlier on. The United States is, from what we're seeing, they're trying to think inwards. Yeah. Now, Brexit is on the other side, thinking about theirs. And with the Brexit phenomenon, European countries are beginning to think, well, we have to re-strategize. So there's less interest on what goes on in Africa, or maybe even Nigeria, in comparative terms. Yeah. Now, if we come home, we see that China is trying to get inroads into Africa and into Nigeria. What advantage?
They are making inroads.
They are making inroads, and they're making even more inroads, and looking forward to more inroads. Yeah. So how can Nigeria take advantage of this open window, very wide open window to China?
You see, actually, Nigeria is such a huge opportunity, which we ourselves are either not entirely conscious of or are not exploiting. You know, we don't have any problem, basically. Our fundamentals are very strong in terms of investment opportunities. The market is there. What is lacking is the policy environment. It's so lacking. No amount of wishful thinking or aspirations will get you anywhere except you do the right things. And it's not rocket science. It's simply just recognizing the primacy of the market economy. That is just it. For as long as you don't embrace these things, what you're doing will amount to more or less voodoo economics. You'll think that, you know, things are going to turn around, you know, with a whole lot of aspirational, you know.
That water will find its level by itself.
It is not just going to happen.
Okay.
You have to allow market forces have its way. That is what happens all over the world. I mean, why are you not regulating the price of
but the CBN will tell you that the exchange rate now.
Why are you not regulating the price of Gary in the market? Why are you not? You see, you just have to recognize the fact that it is the players in the marketplace who can best determine the value of the value. You know, so unless we get back to market reforms, Nigeria is talking about economic recovery and growth plan. If that program, will hopefully come out in February, is not based on market fundamentals, you know, it's not market-based reform, nothing's going to happen. In fact, what we should be emphasizing is economic reform, not economic recovery. Because once you have economic reform, it will just take care of all your problems. So Nigeria as an emerging market is an attractive market, but we are just not doing the right things. Egypt has done the right thing. Egypt has, you know, floated its currency, and things are turning around. We must do the same thing. We should stop just, you know, wishing that things will not just happen unless you do the right things.
Okay, Paul, we'll go on a short break now. When we'll come back, I'd still like to take you on the issue of market and supply and demand forces, which the CBN says is what is happening right now with their new system going on at the foreign exchange market. Okay, so we'll take a short break and return with more.